Year on year, CPI, if you back out food, back out energy, 1.8%. That's better sequentially and also better than estimates. Month on month, you're also seeing a rise of 0.3%. So that's solid. Retail sales also rose by 0.4%. That was bang in line with estimates. If you back out for autos, up 0.4%. So this appears to be a pretty strong report. You are seeing the dollar index off the lows of the session on that news. Now just down 93.36 is how we print. And in the market, you're seeing yields flatter. So if you take a look at the 2-year, that now up over 1%. The 2-year yield taking a big jump after the number. Well, not big. On my terminal, it looks big. But a big jump as you're seeing some selling come in, as this appears to be a stronger inflation retail report, David.
Well, it's interesting. Let's turn to Steve Ricchiuto now.
There you go. That's my jump.
Chief. That's a big jump.
Yeah,
that's right.
You.
Okay, still with us, Steve Ricchiuto, Mizuho Chief U.S. Economist, and Stephen Wood, Russell Investments Chief Market Strategist. So explain this to us. I mean, it's a solid in the sense that it's what we expected, more or less. It looks like pretty much in line with what we expected.
It is in line with what we expected, and I think that's all you need as an excuse right now in this marketplace to get them to test the 260 level, which is kind of what you're doing right now on the 10-year note. I tend to think this attempt through will fail. Even though we're approaching the barrier at this particular moment. And I think the next round of inflation numbers that we get in February for January will be the telltale numbers, along with the retail sales numbers and the payroll numbers. They're all about 3 to 4 weeks out.
I just want to highlight what's happening in the Treasury market. So 2-year yields breaking 2%. That's the first time that's happened since September of 2008. Steve mentioned what's happening with the 10-year inching towards that 2.6 level. We did breach that earlier in the week, but the story today is 2-year yields. 2.02 is how we print the first time since September of 2008. That is a response to better data and a more hawkish feel than from the Fed.
Well, I think you're 100% right there in terms of what people are going to be expecting. The market originally started with 3 were priced in. We were discounting 1.5, 2. Now the market is gravitating towards the idea that maybe the economy is better. Maybe we're going to see more out of the Fed, less out of the Fed. And I think that's why we're give and take in terms of the flattening we've been going through. And now we're slightly steepening the curve, even though the 2s and the 10s we're back up above 50 basis points between the 2s and the 10s. And I think we're going to gravitate up towards a slightly steeper curve until we get through next rounds of numbers. And then I think the expectations of what happens at the front end of the curve will dominate and begin to pull the curve flatter again, but in a rising interest rate environment.